How wealthy families legally avoid 40% inheritance tax. Inheritance tax in the UK is 40% on estates above certain thresholds, such as the nil rate band, £325,000, and the residence nil rate band of £175,000. That can mean hundreds of thousands of pounds going to the Treasury instead of your family. Yet many wealthy families legally reduce or even eliminate inheritance tax. In this video, I'll explain how they do it and what ordinary families can learn from their strategies. Why inheritance tax is affecting more families. Inheritance tax used to affect only the very wealthy, but today more middle-class families are being caught by it. Reasons include rising property prices, frozen tax thresholds, growing investment portfolios. The nil rate band exemption against inheritance tax is now £325,000, but it's been that way since 2009. I mentioned the residence nil rate band for people who qualify for this. It's a little bit technical, but it's £175,000. This means that a married couple can potentially pass on up to £1 million tax-free under the right circumstances. That means the 325,000 plus 175,000 equals £500,000 times 2. But estates above that face 40% inheritance tax. Strategy 1, giving assets away early. One of the simplest strategies is lifetime giving. Gifts made more than 7 years before death are normally outside the estate for inheritance tax purposes. These have an affectionate name. They're known as pets. Don't get confused with dogs and cats. This is known as potentially exempt transfers. So, for example, a parent gifts £200,000 to their children. If the parent survives 7 years, that gift is usually completely free of inheritance tax. But if they die within 7 years, then it can still be caught for inheritance tax, 100% in the first 3 years, but after that, on a sliding scale, it reduces the amount of the 200,000 subject to inheritance tax. Strategy 2, using annual gift allowances. There are several tax-free gift allowances many people forget. For example, there's a £3,000 annual gift allowance. And if you haven't used it in the last tax year either, you can carry forward last year's £3,000 annual gift allowance too. And that's per person, so per husband and wife, for example. There's a small gifts exemption, unlimited number of gifts you can make for £250, but you can't make them all to the same person. I'm afraid that's cheating, and HMRC will get wind of that. Then there's wedding gifts, depending on whether you're a parent or grandparent, can be as much as £5,000, for example. So if you use these exemptions consistently, they can move significant wealth out of an estate over time. Strategy 3, trusts. Trusts are one of the most powerful tools used in estate planning. A trust allows assets to be placed under the control of trustees, and you can be one of the trustees if you're the person gifting, managed for people called beneficiaries, the people who will ultimately benefit from the gift, such as children, for example. And this can remove assets from the taxable estate of the donor or the person making the gift, while still protecting how the money is used. Because if you're a donor or trustee, you're the trustee who's given money away, you can still control it, even though it's no longer owned by you, it's owned by the trust. And when we talk about a trust, think of a trust like a limited company. It's a separate person or a separate body in law, separate from you. Common types of trusts would include ones known as discretionary trusts, loan trusts, pilot trusts. Now, these are just a few examples, but there are many more. Trusts can be particularly useful for protecting family wealth and controlling how assets pass through the generations. Strategy 4, life insurance to cover the tax. Some families use life insurance written into trust. This works by taking out a policy known as a whole-of-life policy to cover the inheritance tax bill. The policy is placed in trust, and it's written on what's called a joint life second death basis, which means the second of the two parties, usually husband and wife, that's when the second person dies, the money is paid out, not when the first person dies. Because if it's husband and wife, inheritance tax is only payable on the second of their deaths, because usually husbands and wives leave 100% to each other first. The insurance payout covers the tax. The estate itself is preserved. So let's say there was an estate of, say, 2 million and the tax was 500,000. The insurance policy pays the tax. 2 million is still inherited by the beneficiaries. Strategy 5, business relief. It used to be called business property relief. It's now called business relief. Certain business assets can qualify for business relief. This can reduce inheritance tax by 50% or even 100%. Examples include shares in qualifying private businesses, certain investment vehicles. This is why some investors hold specific types of business assets as part of their estate planning. Now, you can either own the business assets or own the business itself. Now, there have been recent changes in recent budget. The limit now is above 2.5 million. It's taxed at half the 40% rate, so in other words, 20%. This leads us on neatly to the next big relief called agricultural relief, formerly known as agricultural property relief. Very similar to business relief. Same limits apply. Agricultural assets can receive agricultural property relief, again at 50% or 100%. For farming families, this can significantly reduce inheritance tax on farmland and agricultural property. It means that the farm can be passed down the generations and it stays in the family ownership. But of course, now there's tax above 2.5 million. It's going to increasingly lead to farms having to be sold, sadly. There's the importance of planning early, of course. The biggest difference between families who pay a lot of inheritance tax and those who don't is planning ahead. Estate planning works best when strategies are put in place early. Gifts are made over time. Trusts are structured properly. Waiting until later in life can limit the options available. Let me give you a simple example. A couple with £1.5 million estate, they own a £900,000 house and they have £600,000 in investments. Now, without planning, they could face a significant inheritance tax bill. But with planning, in other words, gifting, trusts, tax allowances, much of that tax could potentially be reduced or even eliminated entirely. 11. Common misconceptions about inheritance tax. Many people believe inheritance tax only affects the very wealthy, but there's nothing they can do about it. But in reality, the system contains many legal planning opportunities. The key is understanding them. Inheritance tax is often thought of as a voluntary tax. I don't think it's quite as simple as that, but it's certainly one where with proper planning you can eliminate your tax bill entirely or reduce it. So, final thoughts. Inheritance tax is often described as a voluntary tax for those who fail to plan. With careful planning, many families can reduce the tax, protect family wealth, pass assets to the next generation more efficiently. So my question to you today is, do you think inheritance tax is fair or should it be abolished? Let me know in the comments.